Hey everyone, welcome to another episode of the Remote Real Estate Investor. I'm Michael Album, and today with me I have two very heavy hitters in the real estate space. John Burns, CEO of John Burns Real Estate Consulting, and Gary Beasley, co-founder and CEO of Roofstock. So without further ado, let's jump into hearing their thoughts and opinions around what's been going on in today's real estate market. John Burns and Gary Beasley, so happy and excited to have you both back on the podcast. Thank you for taking the time to hang out with me today.
You bet.
Hey, Michael, great to see you.
So I, of course, know a little bit about both of your backgrounds and who you are. But for those of our listeners that might not be familiar with who you both are, if you could give us a quick 2-minute, 2-second intro of who you are, where you come from, and what it is you're doing in real estate. And John, if you want to go ahead and start, that'd be great.
Okay. I'm the CEO of John Burns Real Estate Consulting. I founded it back in 2001 to figure out what's going on in the housing market for a lot of people, mostly big companies, and that's what we do.
Love it. And Gary?
Sure. So Gary Beasley, I'm the co-founder and CEO of Roofstock, and we've been at this for about 6.5 years now, building out really the complete ecosystem for single-family rental investors. And I've known John now, I think, John, since about when you started the company. It feels like we've known each other for a while. I think when we met, we both had dark hair, if I remember correctly.
Yeah, then it's been a very long time.
That's great. Well, I wanted to chat with you both around a lot of things that I've been getting questions about, and I'm sure that the two of you have as well. And that's just kind of what's been going on with the housing market and economy over the last couple of years since the pandemic started. So I would love to just jump into things, get into the meat and potatoes, and get both of your thoughts on really year over year, what's been going on at the macro level in the housing market.
Well, I guess I'll go first if you let me go back maybe 3 years. So, but pre the pandemic, because I think it's relevant, the housing market was extremely hot. We have a different view than a lot of people on how undersupplied the market was. We don't think it was undersupplied at all, actually, until about 2019. Then it started to be undersupplied. And with interest rates so damn low everywhere in the world, people had figured out that single-family rental housing was a great investment just to get some yield. And we were seeing a lot of investors come into the market. Then COVID hit. So, investors are very volatile. They stopped for a few months, and then they came back very strong. And probably the biggest difference in the last year is the fear of inflation has piled in on top of the need for yield. And it's double the reason to invest in rental homes. So we're seeing money from all over the world focused on housing in America.
I would agree. Clearly, the residential market has been booming. And I would say, despite a number of factors that you would have thought might have slowed it down. We went through a global pandemic and housing chugged right on through. And we could talk later perhaps about why some of those things happened. But the reality is really kind of across price points and geographies, you've seen robust demand for housing. And if you look at price increases year over year, John, I know you track the SFR space really closely, and it kind of mirrors what's been going on, even if you look at owner occupied sales. But home prices have been going up, call it 15+%, year over year, pretty consistently. That's a big number. When you think about historically, it's been about 4%. If you go back 40 years on a compounded basis. That's how it had been up until fairly recently. So a lot of, and rents have lagged that a bit, but you've seen high single digit to low double digit rent increases as well in a lot of these markets. And so, and oftentimes I feel rents are a little bit of a lagging metric because especially a lot of the mom and pop owners don't raise rents every year or don't raise them really even to market. So we're seeing a lot of homes come to market today that have rents that are 10 or 20% below where the markets are today. So you've got just a lot of demand for the product. We're at an interesting time now, and I'm sure we'll talk about, some of the current dynamics in the market. Interest rates have moved up quite a bit in the last, month to 6 weeks. We've got a lot of interesting things going on geopolitically. We're not yet seeing that impact demand or pricing, one would think that those factors should have an impact over
Right.
time. But for now, I think just the supply demand dynamics very much in the favor of demand over supply.
Okay. Interesting. And I'm curious to get both of your opinions on this. I mean, we are at such a unique time kind of in history, and curious to know your guys' thoughts on, do you think that real estate investing fundamentals have it all shifted because of where we find ourselves today? John, I'll let you go first on this one.
I don't know if the fundamentals have shifted because I've seen this game before. But what is different is that investing in rental homes has become a very easy thing to do, thanks to Roofstock and others. I mean, prior to 2012, you couldn't get on your computer and figure out exactly how much a home was worth and how much it could rent for in about 5 minutes. You can now. Now there's all sorts of vehicles where you can invest in funds and completely passively invest in housing. And I think it's become an asset class that really was very illiquid and pretty lumpy before, that now has become more liquid. And I think that is a permanent change in the market. Doesn't mean things can't go down, but I think it's actually had a permanent positive increase permanently on home prices.
I would agree with John. I don't think the fundamentals. I don't think the fundamentals of real estate investing have changed. But I would say perhaps some of our maybe preconceptions or assumptions about how it would perform, as I kind of mentioned earlier, are maybe a little bit challenged in that there's just so much demand for the product, and in the pandemic, it was almost counterintuitive that home prices would go up and rents would go up. But when you think about the fact that people really demanded shelter, safe shelter, and there was an exodus from a lot of the coastal cities to secondary and tertiary markets, drove a lot of that demand. But I think still the fundamentals of real estate are very much about location and supply and demand. Those fundamentals, I think, are true. I think one of the things we're seeing, though, is perhaps there are different things that can drive demand and pricing for different types of real estate assets. So if you look at, for example, housing and industrial, which have done quite well throughout the pandemic and the aftermath, and then you had some real estate asset classes that really suffered because you look at office and retail and hotels, things like that. So I think real estate broadly can be influenced by different things. The fundamentals of each have to be examined, but certainly for housing, it's been very strong, despite what you might have considered some headwinds.
Okay. Interesting. And you both touched on inflation in the conversation thus far. And so I'm curious to know, how much of the demand do you think is being really driven by inflation? And do you think that folks are right or wrong to be considering real estate investing as a hedge or as a defense against inflation?
People's expenses are going up and your investments should beat inflation, and nothing in the treasury market does it. In fact, nothing in the high yield bond market pretty much does it now too. I don't know how you earn returns, but this was going on pre-COVID, and that's why I mean that there was a surge of money coming into the market pre-COVID. At our conference at the end of 2019, we had Bruce Flatt, the CEO of Brookfield Asset Management, who at the time managed more than $500 billion, was fundraising all over the world. And he literally said that this is the most significant thing he's seen in the last 15 years, is everything that produces cash is going to go up in value. And that was pre-COVID. And so this has just got even more accelerated because inflation wasn't even part of the equation. Now, if you need to beat inflation in your return, and inflation is right now, the latest print is 7 to 8%, where are you going to get 7 or 8%? And so housing, if wages go up, which they are, you can raise rents. If the cost of the structure is going up, which it definitely is, every single component in the house has gone up. The cost of construction has gone up at least 10% in the last year. That's an inflation hedge too, because nobody's going to replicate what you own for the same amount of money. It's very much an inflation hedge.
everything points toward continued inflation, in my view, in the housing market. Now, that being said, interest rates going up, you would think should moderate that. That's an offsetting influence, but the cost of the inputs, the labor and the materials, clearly upward pressure. Everything that's going on in the world disrupting the global supply chain and the cost of transport and all that, putting upward pressure. Wage inflation to keep people in their seats and to hire people. That's allowing people to have more and more money to spend on housing. That's also pulling pricing up. It's hard to see much that's going to, in an absolute basis, reduce the price of housing. I do think that we will see some moderating of the rate of inflation of homes over the upcoming quarters and years. I think that 15% has got to come down naturally, but I don't see it coming down to the point where it actually reverses and you see absolute price declines like we saw in that really unusual time in the Great Recession, which was arguably a once in a generation adjustment to housing prices. There, I think, a lot of fundamental differences between what we're seeing today and what we saw back then. This is not a credit bubble.
So I agree with everything you said until this is not a credit bubble. And maybe you meant a credit bubble in housing, because I agree with you.
That's what I mean. I mean that there's a lot of embedded equity as opposed to people, having 3% or less equity in their homes. They've got 20+% equity. Now you can talk about I wasn't speaking to the global kind of free money credit bubble, but
that's it. I think there's a credit bubble going on in the world on pretty much everything else. I mean, Dodd-Frank made it impossible to do it on a mortgage going through a bank, but people are lending against crypto. It's the highest borrowing against stock prices ever. We're seeing deals even in single family rental that, I would say are being done with pretty much no due diligence because it's a mezz piece. So there's a little bit of equity in front of me. And what I worry about is a recession caused by a credit bubble outside of the housing market, which impacts housing demand. And, that's when housing would struggle. But I think everything else in the world would struggle at the same time, maybe even more so. So I'm not saying get into stocks or bonds because of this. It's just, that's what caused the great financial crisis, and it was housing last time. I think it's other stuff this time. I mean, we're seeing flipper loans are being securitized on Wall Street. I mean, I see that in my business. One of my clients is lending against crypto balances. I think another famous person just came out and said, if you can put up crypto, I'll give you the value of your crypto to make a down payment for a house. There's some different stuff going on that concerns me, but not on buying rental homes for Roofstock, more concerning on the economy.
Okay. And so curious, John, just, personal thoughts. What's a good defense?
Normally it would be cash, but holding on to cash, it goes down 7%
right.
every year. So I think Howard Marks, who's a famous investor, calls this an everything bubble. We're in an everything bubble right now, and how do you invest in an everything bubble? I have no idea. That's why I run a consulting.
Maybe negative interest rate German bonds don't seem so crazy.
Yeah.
Well, no, exactly. So in the coming world, losing 3% is probably a good deal relative to everybody else if that's how that plays out.
All right. Well, I want both of you keeping your eyes and ears peeled, and let me know if you hear something great to hedge against the everything bubble. I'd appreciate it.
Well, it's deal specific. I mean, that's what the smart people aren't doing. They aren't going into just a sector. They're looking at everything carefully. And in this industry, if you don't have a lot of competition going around where you're making investments, that's a far safer place to be. If there's some great job growth and you're confident in that job growth because those employers are profitable and making money and going to be there all the time, that's a different story than the job growth being in a sector that's currently losing money, for example.
That makes total sense. I'm curious if we could take a step back and understanding that neither of you work for the Federal Reserve, but I'm curious to know your thoughts and kind of get some insight into I mean, you talked about the wage growth going up and then the cost of goods and services going up. How do we not get into this upward death spiral? And I know, Gary, you mentioned, raising interest rates could curtail that, but it seems like there's just so much money out there. How do we kind of ease down from this?
Yeah, well, I think I don't know if there's been a tougher, it's never easy being involved with setting Fed policy, but you have a lot of things to balance here. This is a tightrope act. So you want to slow the economy here enough to curtail inflation, yet not necessarily throw it into a big recession. You've got a lot of things going on overseas that you could argue are already going to cause things maybe to slow a bit because of what's going on over there. So do they need to pump the brakes as much here? So maybe that means that the Fed doesn't raise as aggressively here. And what that may mean is, rates grow a little bit more slowly, and maybe the economy tends to overheat despite the global weakness. So it's a really, really challenging balancing act. I think that the Fed is under enormous pressure to curtail inflation. And so I think despite that, it will probably err on the side of pumping the brakes a little bit heavier, even though that may mean we're risking recession. I'd be curious, John, if you have a view, but if I had to, like, on the continuum of what they're more worried about right now, normally I would say that they've been historically more worried about not wanting to put us in the recession, but we've never in a long time had these sort of inflationary pressures. And in particular, where I think people feel it seems to be at the gas pump, right? We're always talking about fuel prices. People feel that very deeply. And there's a lot of political pressure, even though the Fed's, in theory, apolitical. Political pressures tend to work their way into those decisions.
Yeah, in my 30 plus years of paying attention to this, I've never seen the Fed more politically tied than they are right now. They frankly, they seem to me to be puppets of elected officials. I mean, the fact that Powell had to announce for months and months and months they were going to raise rates, but never raised them once until he got reappointed will tell you something. So, I mean, I always honestly think it seems to me like elected officials are calling the shots right now. And I think the ultimate fear is a recession, but we want to get inflation down because inflation isn't good either. And then, the way I think about this too is if you really talk about people's true costs, there's a huge variation in inflation. So if you're a homeowner who owns your car, your housing costs haven't gone up at all. Maybe you got a little bit of a property tax reassessment. You haven't had to go back and purchase a car or release a car. And if you were close to work or working from home, frankly, your cost of living might be down over the last year or two. If you're somebody who's commuting to work, rents, had to, really, your lease was up, had to get another car. I mean, your cost of living could be up 15 to 20%. And the Fed seems to be focused on those people, rightly or wrongly. But that's how I'm thinking about this. Is it's a huge difference in what's actually happening depending on what you are. And then the wage growth, if you're in the hospitality sector, you haven't seen anything. But if you're a construction worker or a truck driver, your wages are up dramatically. And those are the ones that we're seeing that are buying homes, renting homes, people that are affluent, able to work from home. Hey, I can now go out to the suburbs and rent a really nice house, and my housing costs are going to go down, not up, because my boss says I only need to come into work twice a week. So it's a very complicated story I'm painting here, but that's exactly, I think, how the Fed is looking at it.
Yeah, and then you also have, obviously, those who own assets versus not. I mean, this is similar to what John was talking about, but not only can you have the cost of living impacted a lot less if you own your assets, but in fact, John, you may know this figure, but I read it, I think, last week. Some fairly sizable percentage of the U.S. population made more off of their homes this year than they did from their jobs. the power in an inflationary environment of owning assets, it's kind of hard to overstate it. That I think one of the reasons I think we're seeing more and more kind of first timers wanting to own their first investment property, even if they aren't in a position to own the home they're living in right now, going to some of these lower price markets and getting on the ownership bandwagon and just riding that asset appreciation. It's a powerful force.
Yeah, absolutely.
I thought you were going to say a powerful drug.
Well, some people do become addicted to it.
Well, we're starting to see that. So people are taking the $200,000 in price appreciation out of their house with a refi, out of their investment, and then using it to buy 3 or 4 more homes. Right? That's what's going on right now. So it is addictive.
Yeah, no, that makes total sense.
Yeah, well, it's been a tried and true way for real estate investors to make money. Right? Is to buy that first property, refinance it, take that money, buy more properties, and build. But I think, John, to your point, what's happening is a lot of people are doing that with their primary home equity to get started, as opposed to being more of the intentional investor who just started to do that. I think more and more people are doing it with, equity in their homes, which I think in many ways makes a lot of sense from a diversification standpoint, rather than having so much of your wealth personally tied up in a single property address where you happen to live, where you're really subject to the vagaries of your local real estate market, local job market, all that kind of stuff, because that's where you tend to work. To diversify into other markets and other assets, I think does make a lot of sense.
John, would you agree?
Yeah, no, diversification makes a lot of sense. I also think it makes a lot of sense to watch how much leverage you've got and to make sure you've got the cash flow, just in case something bad goes wrong. And I think people that are investing like that and doing exactly what you're saying are going to be great. But last time what we saw was people just were ignoring that. And then you lose your job, and then you lose your tenant and your host. So you got to be careful here. And I think the more, as I'm going to generalize a little bit here, but the more mature people that have seen this before are doing that. And I'm sensing the younger people only think home prices only go up, and I are more willing to take more risk than I would recommend.
John, kind of to that point, I'm curious to get both your guys' thoughts. If someone is taking out equity of their home because interest rates are so low and they've seen the value go through the roof and they're going to go buy investment properties, what's the harm? What's the risk there? I mean, and how does someone know if they are over leveraged, if their cash flow is covering their mortgage payments? I mean, if the value dips, nothing really changes for them from a payment standpoint. So how should people be thinking about being over leveraged, or how much risk is too much?
I mean, that's a very personal decision for folks. Confidence in your employment situation is probably the most important thing. And that depends on what you do.
Yeah, I think, Michael, to your point, as long as, and I think it is an important point, in a rental home portfolio, even if prices drop of that home and you've got a fixed mortgage, your payments don't change, right? And unless rents come down, which they traditionally have not, they tend to be more sticky in single family rentals than, say, in apartments. We've followed a lot of that data over time. So you should be okay, even if on paper the value of your home, your rental home, has gone down. But I think in the primary residence, which is where John, I think, was going, is if let's say you have 60% equity in your home and you lever it up to 90 through various means, then all of a sudden you may be at a point where if you lose your job and you don't have the reserves, you may be in a little bit of a tougher spot because you don't have that home equity to tap, which historically has just been a really nice thing to have as a safety net. And so if that were to happen, you might have to sell some of your other properties, or you have your equity elsewhere, and it's not like you can't necessarily get at it. But I do think in times where you do have some uncertainty, some global uncertainty and some things like that, having some reserves makes sense. Not being over levered makes sense. play the long game. I think that's one of the things that we talk to people a lot about is this is not a,
Mm-hmm.
get rich quick, fix and flip, strategy when you're buying investment
You
properties.
serious?
So over the
Oh
long
man.
run, Michael, you're going to do just fine, but you have to be patient. So no, but there's plenty of ways you could make bets to win quickly, win or lose quickly, but that's generally not what people are doing with us. And I think there's times when people are more risk on. There's a lot of confidence to maybe lever up and things like that. I think this is a time to be a little bit more thoughtful about leverage ratios. And so, yes, you give up some levered return potentially, but if you're in I would argue if you're in a place where home prices are going up at such an extraordinary rate, you don't need as much leverage to get a phenomenal return. Even if you're only 50% levered and your home's going up 7 or 8% a year, at an asset level, obviously you're doing much better than that at a return on equity level. So I would say just don't get greedy. It's a long game, and make sure you're around to fight another day in case there's any sort of corrections.
To play the end of the game.
Well, I mean, that's how I see it too, is get the long game. And that's how everybody who's been doing this for decades will all tell you that that's exactly the way to play it. I am seeing and hearing and running into 20-somethings who aren't listening to Gary's advice. And I have no idea if that's 1% of the market or 40. But they're out there. And fortunately, they're not getting loans from banks at 90% LTV, at least that I can find.
Right.
So that's good.
Michael, you talk to a lot of people all the time. What is your assessment? Do you think people are thoughtful about this? Do you think that do you agree with John that people who might not have seen a down cycle might be overly optimistic, or do you think that they're better informed?
Yeah, I think it's really a mix of the two. I think that there are two big camps. One camp says this is going to go on forever, and that tends to be the folks that haven't seen a recession before. And then there's the folks that say, it's got to come down at some point, and so let's just kind of see what happens. And those tend to be the more seasoned folks. So I'm curious. I'm curious to get your guys' thoughts on for those two camps, and someone who's just trying to get started, trying to get their foot in the door. How should they be thinking about that? Is this something that they can kind of catch on the upswing, or do they really need to be a bit more timid and reserve and say things are maybe a little bit too hot right now? Let me just take a seat on the sidelines and see how this all plays out.
So we've been calling this the high risk, high reward of the part of the cycle now for 13 months. So I would have told you 13 months ago to be cautious. And the person who would have taken a lot of risk would have made far more money than the person who listened to me. So, but that's how these things play out at the end of the cycle. Well, when you take a lot of risk, you should make a lot of reward, right?
Right.
But you also need to know when to take some chips off the table. Unless you believe we're never going to have a recession again, which I don't believe that. And then also what Gary said has been very true for single-family rental rents. The rents have been very stable over time compared to apartments because there's basically been very little construction of rental homes forever. And there's always been a ton of construction in apartments. And that's when you get killed is when, 3 huge apartment complexes open up down the street, totally empty, and have to lease up 500 units, you're done. That even though build for rent is growing pretty significantly in Phoenix right now, it's still a lot smaller level of supply than apartments. So this is a more stable investment than compared to some other rental classes, for sure.
Yeah, it's we like to say it's a lot easier to go up than sideways because if you could go vertical with apartments and it takes a lot more land, and it's typically much more difficult to add the single family rental supply. And then over time, you also have more than one exit on the rental homes because you could exit to a yield investor or ultimately an owner occupant. So that's, I think, one of the things that I've always liked about single family rentals is you've got built-in optionality. It's very rare in a real estate investment to have two very distinct buyer sets on the back end, right? You have an office building, you're going to sell it to an office investor. Same with a hotel. So this is, I think a unique aspect of single family rentals, which gives, it kind of gives investors a bit of a hedge.
Yeah, and that makes total sense. I'm curious, what do you tell investors who come to you and say, John, Gary, I can't seem to break in. All my offers are getting outbid by all cash offers that are 10 to 15% above asking. I can't go that high. How can I get my foot in the door? What should I be doing? What tactics should I be using?
I mean, I might be the wrong person to ask because my clients tend to be very large companies, and this is, for their capital partners, this is less than 10% of maybe of what they're investing in the spectrum, or certainly less than 20%. So they may be all in this industry, but it's not, what you're alluding to is maybe somebody with 100% of their net worth or 80% of their net worth getting in. I don't advise on that. I mean, people are building rental homes with a appropriate amount of leverage in good locations. That's where we're coaching people to go. There's also people building rental homes with a lot of leverage in tertiary locations, right where there's a lot of other construction going on, and that would be, to me, a higher risk scenario. I think there's room for a 100-unit rental community, brand new, built in every city in America of size, because you can there's thousands of people that rent ratty old homes with lousy landlords, and there's a percentage of them that would really love to rent something new. Well, and what's your biggest fear as the tenant? That they're going to sell the house you live in and you're going to have to move out. Well, if you're in a rental community that's owned by a public REIT, they're not selling the house. That fear is gone. They may charge you a little more because it comes with better service and other things. But I think that's a tremendous long-term opportunity, is to build rental homes.
Interesting perspective. Gary?
Yeah, I would say people should do their research and be patient, be opportunistic, but not be afraid to act with conviction when they find things that make sense for them. And so I think what we find is on Roofstock, a lot of times people will come and they will look at properties for months and months and months and talk to people and kind of develop their strategy. And eventually something is going to hit your radar that's going to check most of the boxes. And in this market, when that happens, as long as you've done enough work to kind of know this, then be ready to act. I wouldn't recommend somebody come and buy the first home they see, because then you just don't have enough data. But when you see where these things are trading and all that, and so that's why I say, be disciplined, but also act with conviction when you find something that does work. If you do want to get exposure, otherwise, you could sit back and just sort of watch things. But you can also wait. A lot of times with stock market, also people want to buy on a dip and just wait. Maybe there is a little bit of a correction, and that could be a time for people to want to wade back in. The challenge with waiting for a dip is, as John pointed out, there just hasn't been. Even throughout COVID, there's been no dip. It's just, been up and to the right. And so, I don't recommend people just buy because of the momentum, right? You want to feel good about the markets you're buying in and the home that you're buying, but also it's really, really hard to time a market. It's almost impossible. So
I've heard that.
That's why over time we recommend people not, even if you're only in a position to buy a home now once, but have a design to own a portfolio of them over time and buy them at different points in the cycle. And over time, you get that market exposure. It's hard to time your ins and outs perfectly.
Yeah. Yeah. Okay, cool. Well, I'm curious now to get your guys' thoughts and opinions looking forward, which I know is always a dangerous thing to do, but I'm going to ask you both to take out your crystal ball. And in talking, John, you mentioned about newly built homes, built to rent communities. And so I'm curious to hear your opinions around if the housing starts that we're seeing since COVID are going to have an impact several years down the road, 8, 10, 5, 10, 8 years down the road, kind of like we're seeing now as a result from the 2008 lack of home starts?
Yeah, we've done more research on that than anybody else. There's a couple people with some very simple analysis that says we're short about 5 to 6 million homes. I think we're short about 1.7 million, which is still a lot of homes, and that's not the same shortage in Buffalo as it is in Dallas. So we've got the numbers by market. But at a high level, if we're short 1.7 million homes, there's 1.7 million homes that have brand new homes that have paid for a permit that haven't been finished yet. So we've got all of that under construction. And it's taking about 9 weeks longer to build a house for the best production builders in the country. So this is taking a very long time. So it's going to be at least a year before we satisfy that, because there will be some growth along the way too. So what is different about this cycle is the lack of construction. But what I want to point out is there's this notion that the low level of supply just means that this is almost a sure thing. And I don't think the most important thing for housing has always been job growth. Always. I mean, rates can go up dramatically, but if everybody's got their job, okay, maybe prices will be flat for a while, but we'll be fine. It's when you see massive job losses that we cycle down hard. So that's why I was bringing up earlier the whole credit cycle issues. If we knew exactly how much debt every company had and every industry had and how much they could cover their cash flow, I think I'd have more certainty. Some analysis I've seen is there's quite a few publicly traded companies that aren't currently generating enough cash to pay their debt service. That makes me concerned. They're not in the housing industry. In fact, the home builders have never been better capitalized. Like they're amazing. They're the lowest debt levels ever. And the bonds, and the bonds they borrowed, they don't mature for like 4 or 5 or 6 years. So, I mean, the home build, talk about a safe play in terms of going through the cycle. I think it's the builders. I'm not recommending stocks because I don't do that for a living, because I think all of this is priced in. But I'm telling you, publicly traded home builders are very, very strong balance sheets right now.
Yeah, it's interesting because John does such good research, so I have no reason to doubt the 1.7 million. But I have seen, estimates between 4 and 6 million homes deficit, and so I don't know what the right number is, and I'm sure that there's methodologies that, but it's at least a couple million homes. The question is what does that mean going forward? Do we catch up as quickly? Can we catch up in a year or two? That's, I think, optimistic. I think it'll be interesting to see if we do. Right. One of the things that John mentioned was job growth, and that historically has been a real driver. What I think is so interesting now is jobs are so distributed. And because companies are adding jobs doesn't mean the jobs are going to be where the companies are located. And that kind of makes everyone's head explode if you're trying to forecast what's the impact of job growth. It really comes down arguably more to population growth. So local jobs are one thing, and some things have to be localized, right? If you're going to work at a hotel, the hotel is in a particular place. If you're going to be a software engineer working for Apple, maybe you could be anywhere or any of these other places. And so it's a different calculus than I think it was 10 years ago of trying to forecast job growth from companies. And then, people are going to need to live within a 30-minute commute or 45-minute commute. That's all upside down. So I think it does bode well for some of these secondary and tertiary places that have seen disproportionate growth. But then you also have these places like in Austin that continue to explode, and arguably housing's no longer very affordable, but they keep building more houses and people keep buying them and keep renting them. And there's plenty of land in a place like Austin. And so I think almost looking at where taxes are low and people can still get relatively affordable housing almost seems to be more powerful than local job growth. But I'd be curious about John's view of that.
No, he's right. There's a large sector of the economy where you can live wherever you want, and we've been doing this since before COVID. I was never believed that all the best people to hire in the world were always within commuting distance of my office. So we've been hiring in good locations, but you got to get the right person who can do that, and companies have figured that out now. It is about a great location. It is about where I can get a lot of house for my money if I'm a tenant or if I'm a home buyer, or I can pay lower income taxes, or I can have better weather. So it's really the same places people were moving pre-COVID. It's just more people have been given the permission to move. So you're right. The job growth, it's pretty correlated to the metro area, but I would say the more outlying areas should see more price appreciation, and they are seeing more price appreciation right now because more people are being allowed to go there.
Okay.
Yeah, and it's almost interesting. It's a little bit like the jobs are almost coming with the people. So you think of a place like Boise, Idaho, where people moved there not for jobs necessarily, but because they could bring their jobs with them, and they had all this embedded equity in their homes from more expensive markets. So now you have all these people moving into a market like Boise, and you get incredible growth in the prices of homes in Boise. But now people are working from Boise. So are those jobs created in Boise, or are there jobs that now exist in Boise because it was inexpensive and is a nice place to live?
Yeah, I was going to ask John, does that make it kind of squirrely to nail down that job growth metric because of this new phenomenon?
Yes and no. So there's two job surveys. There's one where they call the employer and said, how many people did you hire this month? That's based on where the employer is located. Okay. But the one where they call people and say, are you looking for work or not? That comes up with the unemployment number. That's where you live. So actually, and we always triangulate the two. So I'll use my example. So we perfect example. I'm in Orange County, California. We hired somebody in Boise, but she could live anywhere. She's showing up here in Orange County on one survey, and she's showing up in Boise in the other. So you need to look at both. The sample size on where the company's located is higher and better, and the unemployment number at the metro level is more volatile. So you got to look at a trend over time and not just overreact to a month or two.
Oh, that's super interesting. Okay, and great to know too. So the last question I have for you both, and I think I already know the answer, but for everyone listening, I'm going to ask on their behalf. In your guys' opinions, have there been asset classes that have become more valuable and less valuable as a result of the pandemic? And if so, what, in your opinion, are they?
You can handle crypto, Gary. I'm not going to touch that one.
All right. Well, why don't you start then?
As I said earlier, I think new technology, which was not around prior to 2012, has allowed the single-family rental business to just blossom permanently. And it's now going to be a permanent part of people's portfolio, passively investing in real estate. And that has already pushed up prices more than it would have. And going forward, whatever price appreciation would have been otherwise, it'll probably push it up a little bit more. The only thing you have to concern yourself with there is, the government doesn't like that, and they tend to be pro-home ownership. So you got to watch regulation. I am seeing a lot of our clients tend to avoid California because they're afraid of rent control. So, and there was just a Bloomberg article that 12 different states have had rent control proposed because of all of this. So you just got to keep your antenna up on that side. But the rent control that's being proposed seems to be more reasonable. It's at the rate of inflation, or maybe 1% higher than that you can raise rents. It's not, it's zero or something ridiculous.
Okay. And what, in your opinion, has been devalued or become less valuable, if anything?
I can't think of anything that's become cash.
Yeah.
Okay.
Yeah.
It makes sense, right? I mean, you're losing. I mean, John mentioned. I mean, if you have money sitting in your checking account right now, it's 0.001%, and you've got 6, 7, 8% inflation. That's how much you're losing by sitting in cash,
Right.
and so that does create a real incentive to put it somewhere. And I would say, Michael, I mentioned this earlier, but I think housing and industrial, which is driven a lot by distribution for e-commerce, a lot of those have been really darlings for investors. They've become very much in favor. And I do think you're still seeing some challenges and some questions about office space demand. And, not that there aren't always office investors and there aren't always going to be people in offices, but there's probably structurally some percentage of less space that companies are going to utilize. And so that puts maybe some uncertainty into the minds of investors. If there's another, I think a lens investors are looking at today is, okay, there's going to be another pandemic someday. What are the likely implications of this? And, office, retail, traditional retail was hurt by the pandemic, but it was also being crushed just by Amazon, right? And so that's, I think, got its own challenges. And then hospitality is just very cyclical anyway. And if people stop traveling, they didn't travel for a while. So those I think are, maybe a little slightly more challenged than housing, which is proven to be much more resilient than I think most people thought. And as a consequence, you have a lot of investors, not just traditional or not just individual investors or institutions from here, but people from all over the world saying, "Wow, U.S. housing looks pretty interesting relative to other places that they could invest."
Yeah.
Yeah. There's something we take for granted here called title laws that don't exist in other countries. I mean, people in other countries don't want to buy real estate there because the government could take it away from them. And I hear that from foreign investors. That's one of the things that they love about investing in America.
Pretty scary notion if you had to be overseas.
Well, I should have mentioned everything that Gary said too. I mean, there's a lot of huge funds, pension funds, who like to put a percentage of their assets, say 10% in real estate all the time, and it would traditionally go into retail and office and hotel. Do you think they're ever going to go back to the same percentage of retail, hotel, and office? Probably not. It's going to be far more in this business because retail is now industrial. I mean, it's a warehouse. And inline, the best retail centers are all going to be fine in the best locations, but their inline space is dead. So you're right. That's going to push more money into our business.
Okay. Well, guys, this was super informative. I know I had a lot of fun. Hopefully our listeners did too. If people want to learn a little bit more about each of you, where's the best place for them to do that?
We've got a website, realestateconsulting.com. I post pretty regularly on LinkedIn, so you can look up John Burns on LinkedIn and get some free stuff every day. I
love the free hoodie that you got right there, Michael. John, I know you've got a Roofstock hoodie as well. I don't know if you ever wear it.
I do. I should have brought it today. I'm sorry.
Could be all three matching.
I should.
So, I think I would just encourage people, if they want to learn more about what we're doing at Roofstock, just come to roofstock.com. You could also follow me or hit me up on LinkedIn. I post pretty regularly there as well. And keep checking out the podcast. I know Michael's been doing a great job along with Pierre and the rest of the team here, trying to get. They couldn't get any interesting guests this time, so they got John and me. But I know they've been otherwise getting some pretty interesting folks and doing a great job.
Well, I saw that you're in one of the top 1% of podcasters in the world. Hopefully we didn't push you down to 2%.
A filler episode. No, this was great, you guys. Thank you.
So not.
Thank you so much for taking the time, right. And very much looking forward to chatting again as we continue along this crazy trajectory that we're on. All right, everyone, that was our episode. A big thank you to John and Gary for taking the time out of their extremely busy schedules to hang out with me and chat about what's been going on in the real estate market and where we might be headed going forward. As always, if you liked the episode, feel free to leave us a rating or review wherever it is you get your podcast, and we look forward to seeing you on the next one. Happy investing.